If you have $1 million saved and you're working towards $2 million, or maybe you already hit it, here's something you need to understand. That second million, it might not give you as much as the first did. Here's what I mean by that. The second million absolutely creates more spendable income. That's obvious. But depending on where that money sits and how you pull it out, your income could cause more of your Social Security to get taxed. It could push your top dollars into higher brackets. It could even raise your Medicare premiums. So $2 million gives you far more flexibility than $1 million. It just doesn't automatically hang you twice the after-tax retirement income you expected. So in this video, I'm going to walk you through two real scenarios: a married couple and a single retiree, both with $2 million, and I'll show you the monthly income $2 million generates, why the second million provides less than you'd expect, and what these people do to make it go further instead of turning into this giant pile of tax and anxiety. I'm Tyler. I'm a financial planner at Riverbend. Let's get into it. And real quick, if you want someone to look at your $2 million and show you how much of it's working for you versus how much of it might go to taxes, that's what we do at Riverbend. There's a link in the description below to book a free discovery call. All right, let's meet our couple. So first we got Greg and Sandra, both 64 years old. They have worked hard, they saved well, and they're ready for the next season. Greg spent his career in commercial real estate. Sandra was an office manager for a small dental practice. And honestly, if you talk about work, they're going to quickly change the subject. They want to talk about their 5 grandkids, the trip to Spain they booked for next spring, and what they want this chapter of life to look like. And it wasn't always that way. But today, their identity isn't wrapped up into their careers. They've been very intentional about what they want retirement to be. And now the big question is whether their money is going to support the lifestyle they want to live. Here's their snapshot. They've got $2 million, $1.3 million in Greg's traditional IRA, $400,000 in Sandra's, $200,000 in a brokerage account, and $100,000 in cash. Home's paid off, and it's worth about $750,000. Now, after we build their budget out, they want to spend about $150,000 a year. Now, that might feel high for you. But between flying to see family, the Spain trip, and the experiences they've been putting off for 40 years, that's what the number comes out to. And look, these are the go-go years. This is the decade you're going to do the things you saved for. And remember, spending in retirement isn't a flat line. It's higher early on, and then it trends down as you slow down. Because at some point, believe it or not, it's likely you're going to slow down. So maybe this isn't their budget for the next 30 years, but it is the budget for the part of retirement they've been waiting for. Like a lot of couples, they assume $2 million generates $150,000 a year, no problem. And at a glance, it seems the portfolio can sustain that. But at a glance isn't a phrase I want to build a retirement plan on. It still has to hold up against poor early returns, a long life, taxes, and healthcare. Now, the old advisor, prior to us, they ran a Monte Carlo. They told them they were looking fine and pretty much left it there. What no one showed them was which levers they could pull or what the plan does when it's under stress. So let's take a deeper look. The interesting part isn't whether Greg and Sandra can spend $150,000 a year. It's how much of that second million they're going to keep. So where does the second million go? Greg and Sandra want $150,000 a year. That's $64,000 before Social Security. All of it's going to come from their savings. $150,000 a year on a $2 million portfolio is a 7.5% withdrawal rate. Now, higher than what you would want maybe as a permanent number, but it's temporary. They're bridging the 3 years until Social Security starts, and then the pressure is going to alleviate a little bit. But here's the comparison that matters. A couple with $1 million pulling $150,000 a year out would be at a 15% a year withdrawal rate. That's not a plan. That's a countdown to destruction. So the first million doesn't get them anywhere near this life they want to live. It's the second million that makes that $150,000 a year possible. The problem shows up on the tax side, and it's because of where the money's coming from, which is mostly pre-tax accounts, and this is going to create a future issue if not handled correctly. So let's see what happens after the bridge years when Social Security kicks in. At 67, Greg's Social Security comes in around $3,400 a month. Sandra's around $2,200 a month. Combined, $5,600 a month or $67,200 a year in guaranteed income. With inflation, at this point, their spending has grown to about $162,000. And a quick note here, This is a part people skip. If you project your spending forward without weighing your return against inflation, your future number is going to be wrong. So Social Security covers $67,000 of it, and then the portfolio fills about $95,000 of the gap. Here's where it gets a little tricky. That Social Security stacked on top of their withdrawals pushes their total taxable income up. And once you cross certain lines, you open doors that didn't exist before. First thing is, their Social Security gets taxed. If you're below a certain income, very little of your benefit is taxable. As your income rises, up to 85% of it becomes taxable. Greg and Sandra, they're hitting that ceiling. Second is Medicare. There's a surcharge called IRMAA. You might have heard of it. It's an income-related adjustment to your premiums. If you cross that line, your premiums are going to jump, and that's for both spouses. Now, Greg and Sandra, they're not over it, but you rarely cross that line through ordinary spending. It's one big year, a large Roth conversion, a property sale, one spike, and the surcharge follows you 2 years down the road. So let's zoom out. The first million brought them some sense of safety and a comfortable life. The second million allows for more income, but it's going to push them into higher brackets, pull more of their Social Security into the taxable column, and get them really close to IRMAA. That's the diminishing return of the second million. And unfortunately, it's going to start giving more to the IRS than the first million unless they change how it's built. So, what do you do about it? Well, they have two levers they can pull, and they work on different timelines. The first lever is the brokerage account. When Greg and Sandra take $10,000 from a traditional IRA, generally the whole $10,000 counts as income. When they sell $10,000 from the brokerage account, only the gain counts. The rest of it is their own money coming back to them, and that's money they already paid tax on. That gives them control over what shows up on the tax return for the same $10,000 of cash flow. But cost basis changes everything here. So let's say that they have a $200,000 brokerage account and it holds $140,000 in gains. If you sell $10,000, about $7,000 of it is taxable. Still better than $10,000 of the ordinary IRA income. But now flip it. If most of that account is money they already put in, higher basis, the selling barely moves the taxes at all. So you've got the same $200,000, but two completely different tools. And I'll add one more thing here, because 0% capital gains, it's something that gets thrown around like you got free money out there, and it's real, but with Social Security in the picture, it's not completely free. When they take a gain, it could push more of their benefit into the taxable column. So a $1,000 gain taxed at 0% could still pull in $850 of Social Security, and that $850 gets taxed at 12%, about $100. So the gain itself costs nothing, but it still added $100 to the tax bill. That's why you have to look at the whole return together, not just one number at a time. Now the second lever is used before Social Security starts. So Greg and Sandra, they have $1.7 million of their $2 million in traditional accounts. Every dollar of it is going to come out as ordinary income. The brokerage lever can help, but it doesn't necessarily shrink the future problem that's coming their way, the RMDs. That's where the 3 years before Social Security may be the most valuable window for Roth conversions. In those years, they can move selected money out of the traditional bucket and into a Roth at the rates they control before benefits and required minimum distributions stack on top of everything. And listen, this is not a convert everything conversation. Their $150,000 cash flow need already fills a big share of their brackets, and any conversion would stack on top of that. They'd have to weigh the tax paid today against the taxes and Medicare premiums it helps them avoid later down the road. In the window, it doesn't just shut at 67. They could still convert after. It's just that once Social Security is on, every extra dollar pushes them towards more tax and potentially IRMAA surcharges. So here's the answer. If Greg and Sandra drain the pre-tax accounts the default way, they're going to hand the IRS about $15,000 a year. 85% of Social Security is taxable, and their top dollars taxed at 22%. Now, they still live well, about $12,000 a month to spend. But every year they're leaving money on the table. Here's the other version. Same life, same trips, same savings. They just get deliberate about where each dollar's coming from. Less from the IRA, more from cash, and more from the brokerage accounts. And watch what happens. that taxable slice of their Social Security, it drops. Then they settle back into the 12% bracket. Then the tax bill comes in around $6,000. Same savings, but now they're getting a little bit closer to $13,000 a month instead of $12,000. So they got roughly $9,000 a year for doing nothing different except being intentional. Same $2 million. The difference wasn't the market, it wasn't how much they saved, it was whether they let that second million become income or let it become tax. Now, here's where this gets interesting. Everything I just walked through, the taxes, the surcharge, the thresholds, all of it hits a single person harder and faster than it hits a couple. $2 million as a single retiree is a completely different animal. Let's walk through it. Meet Diane. She's a retired pharmacist. She's 63 and lives just outside of Phoenix. She's a disciplined saver, $2 million saved, $1.5 million in her traditional 401k, $300,000 in a Roth, $200,000 in a brokerage account. Home's paid off, and she wants to spend about $80,000 a year. Here's the hard part. The brackets are much more narrow for singles. Diane assumes her $2 million works about like a couple's $2 million, but it doesn't. As a single filer, she hits the thresholds faster. And it matters because most of the numbers that people throw around and a lot of advice you get on the internet is really geared towards couples. So you hear these numbers and you see these limits and they're built for couples, not singles. Let's look at Diane's situation. So she wants to spend about $80,000 a year and is 63. Before Social Security kicks in, that's a 4% withdrawal rate on $2 million. That's sustainable. And again, the first million alone couldn't safely carry $80,000 a year. The second million is what makes her life work. It's the same as the couple. But watch the tax side here, because this is where things get a little bit tricky. At 67, Diane's Social Security is about $3,300 a month, or $40,000 a year. Her spending, grown with inflation, is around $90,000. So the portfolio covers a $50,000 a year gap. On $2 million, that's under 3%. But here's the thing about being single. Every one of those thresholds we talked about, where Social Security gets taxed, the brackets, the IRMAA line, that's all set roughly twice as high for a couple as it is for a single. So at 67, spending $90,000 a year, Diane already has 85% of her Social Security taxed, and her top dollars are in the 22% bracket. That's costing her about $9,000 in federal tax on $90,000 of income. But that's not where it ends, because she's also got $1.5 million in her traditional 401k. So by the time she's 75, that account might have grown to roughly $2.2 million. And at 75, the government's going to stop letting it sit. Required minimum distributions are going to kick in and force out about $90,000 a year. Diane, she only needs about $60,000 from it to fund her life, but the government's going to make her take $90,000. So that's $30,000 of income she didn't ask for, she didn't need, and now she can't refuse it. And so that forced withdrawal, stacked on top of her Social Security, pushes her income to around $140,000. Here's the thing. She's still in the 22% bracket, and she's still under the Medicare surcharge line. So on paper, she's fine, but look how little room is left. In today's dollars, she's sitting inside about $12,000 of the IRMAA line. And IRMAA is not a ramp. It is an absolute cliff. So $1 over and she pays the full surcharge for the whole year, 2 years down the road. Only $12,000. That's one capital gain she didn't plan for, one conversion, 1 year she sells something, and then every year that account keeps compounding, the margin gets thinner and thinner. So Diane's challenge is the couple's challenge, but with less room for error. She's got to be more deliberate. Let's look at what's coming ahead. At 67, her tax bill is around $9,000. By 75, once RMDs hit, it's going to be closer to $12,000 or maybe even $15,000, which makes the years between now and 75 the most valuable ones she has. That's the window to move money out of that $1.5 million pre-tax account and into one the government can't require withdrawals from. And I want to be careful, because Roth conversions can get pushed as this absolute cure-all, and that's not what they are. For a lot of retirees, converting is the wrong move. But for Diane, this is a very specific case. She's a single filer, she's got a pre-tax balance growing faster than she can spend it, and she's got a hard threshold just $12,000 away with no way to undo it once she crosses. That combination is when this conversion conversation should be happening. You change any one of those facts, and the answer might easily flip the other way. So she isn't converting to beat a higher tax rate. She's at 22% now, and 22% later, she's converting to stop drifting towards the cliff. And she leans on the Roth and the brokerage money to keep her reportable income under those lines that trigger the penalties. So for a single person at $2 million, deciding which dollar comes from which account is the difference between the second million funding her life or potentially funding surcharges. So what does $2 million generate for Diane? Well, left alone, the second million keeps compounding into an account she doesn't control the exit from. And by 75, she's still in the 22% bracket, but now she's about $12,000 from a Medicare surcharge, and that margin shrinks every year. You could do the opposite of what most retirement advice tells you and spend the taxable accounts first, let the pre-tax ride and let it grow. And then her RMD isn't $90,000, it's $134,000. Convert too much at the wrong time, sell a property, harvest gains, and she's into a surcharge and potentially a 24% tax bracket territory. Same $2 million, same spending, same returns, much different tax bill. So what does it actually put in her pocket? At the life she's chosen, it's about $6,800 a month after taxes. But here's the tightrope. The money to spend more is right there in her account. She could take another $1,000 a month without blinking. But as a single filer, the room to pull is narrow. If she pushes a little, then more of her Social Security could land in the taxable column. Push again, or have one big year, a large conversion or a home sale or a fund that hands her a gain she didn't plan for, and now she's over the Medicare line paying the surcharge 2 years later. That's the part that catches people off guard. So for Diane, the ceiling isn't what the portfolio could afford. The portfolio's fine. The ceiling is what the tax code will let her take before it starts charging her extra. Her whole job now is steering and staying under those lines on purpose while keeping an eye on all the thresholds. So that's the real answer on how much income $2 million generates. But here's what most people get wrong when they try to fix it. They hear control your taxes, and guess what? They sprint to Roth conversions because that's what every video on the internet's telling them to do. And if you're under $2.5 million, that advice might cost you money. I made a video right here breaking down why retirees in your range should think very differently about Roth conversions than what the internet's saying, and then what to do instead. If you're anywhere near this number, that's the one I'd watch next. I'll see you there.